Hey traders, this is Corey Mitchell with FX at the Street. I'm going to do a video on position sizing, and more importantly, we're going to look at alternate position sizing based on maximum drawdown. Maximum drawdown, we're going to talk about what it is. It's something that a lot of people don't even know what it is, let alone what their maximum drawdown is for the strategy they're using or for the investments they have. So we're going to look at why it's such an important component and how thinking about maximum drawdown and working it into your trading plan and your position sizing can really reshape how you're trading overall. It can show you where you can take on more risk, where you may need to reduce risk, and it's really a great tool. So we're gonna go through that. We can use this method to account for the risk of any strategy or investment, and it allows us to calibrate our personal risk tolerance to how much capital we're going to deploy. The method can be used on various strategies and investments at the same time, assuming that the strategies are uncorrelated. So we're going to talk a little bit more about that as we get into the actual position sizing based on maximum drawdown. So to kind of give you a frame of reference, I'm going to talk about a couple different typical position sizing methods. These are fairly commonly taught. And then we'll go into how to incorporate maximum drawdown to really improve your position size and to calibrate it for your own risk tolerance and for your own strategies. Because some of these general position sizing strategies may not be ideal for you, even though they're generally taught and they work well for most people. Maybe you're a really good trader and you could actually be taking on more risk than what these strategies or these typical position sizing strategies say that you can, or maybe you're struggling a little bit and these position sizing strategies are actually giving you too much risk. So one of the first methods, and one that I teach a lot and recommend most people use, it's good for most people, is the percent at risk. And we're going to choose an account risk. And I've given these terms to kind of differentiate what kind of risks we're talking about. So when I'm talking about account risk, I'm saying how much of your entire account are you willing to lose on a single trade. So if you have a $50,000 account and you say, okay, I'm only willing to lose 1% on a trade, that means you can lose $500 per trade. That doesn't tell us anything about our position size though. All that says is that we don't mind losing $500 on a trade if we have a $50,000 account. To find out what our position size is, we need to know that, our account risk. Then we need to look at our trade risk. Our trade risk is the difference between our stop loss and our entry point. So throughout this course, I've thrown in some stock examples, some currency examples. I talk a little bit about investments. So there's a little bit of something for everyone, so you should be able to pull out what you need for whatever market you're trading and whatever time frame you're trading on. So the first example here is a long entry in a stock at $90. You place a stop loss at 87. You're risking $3 on that stock. That is your trade risk. Now, in order to get your position size, you divide your account risk by the trade risk. So you're going to take $500, that's how much you're willing to lose in your account, divided by the $3 you're willing to lose on the trade, and you get 166 shares. Just for reference, that 166 shares at $90 will cost you $14,940 of your $50,000 account. Next example is a currency example. You go short the Euro USD at 115.15 and place a stop loss at 116. That's 85 pips of risk. There's one extra step here because currencies have different pip values depending on what currency your account is denominated in and the currency pair you're trading. This pip value could be different. But with the Euro USD, assuming you're trading a US dollar account, you can go $500 divided by your trade risk times the pip value, and in this case it's $1 per mini lot. So 500 divided by 85, 5.8 mini lots. the number of lots is always in the first currency. This doesn't matter too much when you're trading currencies, but just so that you know. So if it's 5.8 mini lots and you're trading the Euro USD, that's always in the first currency listed. So that's actually 5,800 euros, which if you have a US dollar account and you're trying to figure out how much margin or something you're using, that would be $6,438 US that you'd be using of your $50,000 account. So that's the percentage model. There's another position sizing model called fixed dollar, and you're going to choose a dollar amount you're willing to put in each position. So a swing trader with a $50,000 account may say, I'm willing to put my money into 5 different trades at a time, which essentially means I can put $10,000 into 5 different positions. So you're kind of capping how much you put into each stock. So typically, assuming the trades have about the same risk, you're going to put $10,000 into each one. Now, if a stock's a little riskier than some of the others, maybe only put $5,000 into it. If you're trading something that doesn't move as much, so there's less risk in that trade, then maybe you double your position. So the deciding how many positions you can take in your accounts, your kind of a way to calibrate things. It's like your baseline, and then based on how risky things are, you could potentially add a little bit more to a position or take a little off, but you're going to use that as your general guideline. So we'll talk a little bit more about that as we go through some of these examples. A stop loss is still applied to each trade to control the risk. So even though you've said, I'm going to buy $10,000 worth of stock or $10,000 worth of currency, you're still going to put a stop loss on that because there's no reason to risk the entire amount. Because if you lost that $10,000, that's a 20% hit to your account. There's no reason to lose that much. So a stop loss is still applied to each trade. A couple examples here. Assume you buy a stock at $35. You place a stop loss at $33.25. That's $1.75 of trade risk. You could convert that to a percentage to kind of help you see how risky your trades are relative to each other. So that's about 5.8% trade risk. And I picked this because when I am trading stocks, most of my trades are calibrated to around 5%. The difference between my entry point and my stop loss is typically about 5% of the entry price. So then that allows me to go back to what I talked about here, is if the trade risk is about 5%, then I'll put, in this example, $10,000 into the trade. If the trade risk is 10%, say I'm risking $3.50 on a trade, and the entry price is $35, that's going to end up being about 10% trade risk. That's double the risk I'm used to taking, so maybe I drop my position size down to 5,000. On the other hand, maybe I'm trading a really stock that doesn't move as much and my trade risk is only 2.5%, 3%. That's about half of what I'm used to, so I could actually double up my position size because I'm going to end up at this 5% risk to the trade risk. So let's move on to a currency example. Let's say you buy the British pound USD at $1.31.20 or $1.31.25. Stop loss at $1.30.25. That's 100 pips of trade risk. Again, you could convert that to a percent just to give you a baseline, 0.76%. If you have trades that deviate quite a bit from that, you could adjust your position size for that, as we discussed before. And with currencies, since you have access to more leverage, you could fine-tune the leverage you want to take. This is a little tougher to do in stocks because if you're swing trading, you're limited to 2-to-1 leverage. But in currencies, let's say you are going to take your position, you figure out, we'll talk about what the position size is going to be in just a second. you could just double it or triple it or quadruple it to give yourself 2, 3, 4 times leverage. So you can specifically control how much leverage you're using with this strategy. So let's just look at how we would calculate our position size based on this model. Remember, we're using $10,000 of our account. So for the share example, $10,000 divided by 35, and we're just doing this simply because we've already chosen we can only invest $10,000. So then all we have to figure out is how much we can afford to buy of that currency with the $10,000. So in this case, $10,000, we are paying $35 for the stock. We can buy 285 shares, and that's going to cost us just under $9,000, or just under $10,000. For the currency example, as I mentioned, British pound, that's if you buy $10,000 worth of the British pound USD, that's going to be pounds. So if you buy 10 mini lots, 10 mini lots, that's going to be, 1 mini lot, 10 micro lots, that's going to end up being 10,000 pounds. So you have to convert it. If you're using a US account, you'd have to convert it to US dollars. So you divide it by the exchange rate, and you'd end up buying 7.6 mini lots, because that would end up costing you just under $10,000 US. Now, if you wanted to leverage it, let's say you're comfortable with 3-to-1 leverage, then you would simply multiply that by 3. So you know what the position size is that you're going to take, and you'd multiply it by 3. So in this method, you're basically choosing a dollar amount you're willing to invest in, and you just invest that amount. So let's get on to what this presentation is really about, because those position sizing methods, they're all good, but I think we can really tweak them to A, our own personal risk tolerance, and B, what our strategies and our investments that we've chosen are giving us. So the maximum drawdown really helps cinch things up and make sure that we're really maximizing our strategies and just fine-tuning it to what we need as traders and what we're looking for. So maximum drawdown is the most your account or investment has dropped before it recovers. There's a few examples here. If your account was at $20,000, dropped to $18,000, you lost $2,000 of your $20,000, that's a 10% drawdown. A drawdown continues until you've recovered the money. So if you were at $20,000, dropped to $18,000, went up to $19,000, dropped to $17,000, you're still in that drawdown until you get back up to $20,000. So if you drop to $17,000, that means your drawdown's bigger. You've lost $3,000 out of your $20,000, so that'd be a 15% drawdown. So the drawdown continues until you've made back the money. 100% or 100,000 down to 80, that'd be a 20% drawdown. For historical reference, or for more for investors who are buy and hold, I thought it was important to put in what your typical drawdowns are, because people don't usually think about this when they choose an investment. They hear like, oh, the S&P goes up 10% a year on average over the last 100 years. What they forget, though, is that during the bad periods, you are going to have 50% drawdowns. There's been 2 in the last 20 years where you would have seen your account drop by half. So if that is too gut-wrenching for you, you have to take that into account. And we're going to talk about how to kind of minimize those risks and find out where you're comfortable. If you hold like a gold mining ETF, you could see an 80% drawdown. If you hold junk bond ETFs, you could see a 25 to 50% drawdown. If you hold just like a total bond fund, something that's considered very safe, a bond fund that just has lots of different types of bonds in it, municipal bonds, corporate bonds, government bonds, you still could see a 9 to 15% drawdown before it recovers. And that's important. And I put, on these ones, I put these ranges, and I really could have done it on all of these. The smaller range is if you don't think a major downturn is going to happen, like what happened in 2008 or the year 2000, where you have like these major crashes that really affect the economy and affect really every investment. In those types of events, you would have seen junk bonds fall by 50% at least. You would have seen your total ETF, potentially bond funds, fall by 15%. So in bad times, you're going to see these like really big moves. If you think that we're maybe in a time where that's very unlikely, then you could potentially base your maximum drawdown on these. So you would think, yeah, the maximum drawdown I'm likely going to see in a junk bond's 25%. If you're a little more pessimistic and think, yeah, I want to factor in the fact that we could have a major drop, then you pretty much have to assume that you could lose 50% of the value, or in like a more stable bond fund that you could at least lose 15%. The point of this is that your maximum drawdown in your account or in your investment could be different than what you actually want. If this is disgusting to you, 50%, something has to be done about it. If a 10% drawdown is nothing to you, you're like, in order to make more money, I could easily draw down 15, 20%. If it means making more money, I'll do that. So assume a trader has a strategy that has a maximum drawdown of 15%. They found that they've been trading this strategy, or maybe they've extensively backtested it over several years, and they find the strategy that has a 15% drawdown, and in exchange, it tends to produce 30% a year, or whatever percent. These can be anything you want, 5%, 15%, pick the number, but the point is, you need to know what the strategy you're using, go through your own trades, and look at what your worst period was before it recovered. That's your maximum drawdown. If you look at your investments, what was the biggest downswing in your account? That's your maximum drawdown. And then what can you reasonably expect to make? So these can be really any numbers. You can plug in your own. Ideally, you want to base these numbers on as much data as possible, so ideally hundreds or thousands of trades. This, therefore, is a little bit more of an advanced strategy. If you're just starting out and just learning a strategy, you're not going to really be able to apply this method because you won't know what your maximum drawdown is yet. You can go through back testing and you can get a pretty good idea, and we'll talk about how to do that a little bit more. So the point is this trader, has maximum drawdowns of 15% and he's making 30% a year, but he could actually double his position size if he's okay with the risk and make double the returns. So he could go from 15% drawdowns to 30% if he's more comfortable, simply by doubling his position size. And in doing so, he can potentially double his returns for the year. Right? If you were making 30% on X position size and you multiply X by 2, you should be able to double your returns. So we can risk more and make more. The flip side of this is there's probably a trader out there who's seeing drawdowns that are way too big for them and they're super stressed out. They can't sleep. They're getting out to check their charts at night. And assume maybe they draw down 50%, but they want to get to that 30% or 25% level. So if they want to reduce their drawdowns to 25% of their account, they'd have to reduce their position size by half. If they want to drop it down to 30%, they'd have to cut their position size by 40%. This is going to reduce the profit too. If you're taking those big drawdowns, unfortunately, you can't really have one without the other. So you're going to reduce you are going to reduce your profit by reducing your position size, but at least you get to sleep at night, and you can still put those funds you're not using, because now you're not using as much capital to fund those positions, and you can put those into something safer. So you're losing out maybe a little bit on your investment or your strategy, but at least take that money and throw it in something else. If you're not going to be using that capital for your position size, throw it in, maybe it's a bond fund or one of those lower risk investments where you're going to make a few percent, or just throw it in the bank in a term deposit or certificate of deposit where you at least make a few percent. So another example would be the S&P 500, which a lot of people use as an investment vehicle for their retirement accounts. They're just basically buying index funds like an S&P 500 type fund, whether it's a mutual fund, ETF. And it does have 50% drawdowns. If that's uncomfortable and you only want to see 30% drawdowns in your account, at least in that S&P portion, don't invest everything in the S&P 500 ETF. Put a little bit into something that's safer, balance it out. And this is what a lot of financial planners walk through with people. They try to assess your risk tolerance, and then they'll put some in stocks, some in bonds, maybe some in currencies, some in gold. So what they're trying to do is like sort out in kind of a subjective way, a way to help you sleep at night but still keep your returns decent. But this really fine-tunes how you want to do it. Once you know what your drawdown is, you can say, I'm comfortable with this level of drawdown, and then you can choose position sizes based exactly on that. So it's much more specific. You know exactly how much you need to reduce by in order to move out, or in order to reduce your risk. So how do we do that? Final point here is always know your maximum drawdown. If you don't know what your maximum drawdown is in your strategy or investments, then you've put yourself at a huge, huge disadvantage. So how do we actually find our position size using max drawdown? This first, when we're using this method, we are talking about when your trade risk is about the same. We talked about that a little bit before with the fixed dollar amount. If your position sizes or the trade risk is about the same, this is the method you can use. If you kind of take your trade subjectively and each one has a different trade risk, then just do, let me just find the slide again here. Then just do kind of what we talked about here. So if you know that you overall you have 20% drawdowns a year and you want to increase that or decrease that, just multiply each position by whatever you needed to do. So if you were at 15% drawdowns and you wanted to increase to 30 to increase your returns, you could essentially double each position size. Or if you wanted to reduce this, you were at 20% drawdowns and you wanted to reduce it to 10, then you'd half your position sizes. If your stop losses are the same, we can find out exactly how much we should be trading. So I have a forex example and a stock example. So I tested for a Euro USD strategy, which I currently use, and found that it lost 600 pips at its worst point. And the strategy always uses a similar stop loss. It changes once every year or so. I'll adjust it for volatility, but typically if volatility is pretty much the same, it has a 40 pip stop loss. So what this essentially means is that I could lose about 15 trades in a row losing 40 pips. So that'd be during a just horrific period. Maybe it's just whipsawing back and forth or something. Extremely unlikely. This scenario occurs once in 5 years, but it is still the maximum drawdown the strategy can take, or that has taken. So that's the worst. And if it's still profitable through that, I know it's a good strategy. And this one happened to be, so even though it lost 600 pips at its worst point, still profitable. We're going to use it. So once you know what your maximum drawdown is, or what the worst drawdown has been, you're going to decide what percent of your account you're willing to see eroded by that maximum drawdown. So you get to decide what that 600 pips is worth. Is it worth 10% of your account? Is it worth 30% of your account? So if you have a $100,000 account and say, you know what, I'm only comfortable with a 10% drawdown, that means you're willing to lose $10,000. Then you're going to divide that by the maximum drawdown. So $10,000 divided by 600 pips, you can trade 16.6 mini lots. If you have a $15,000 account and you say, you know what, I'm willing to risk 30% of my account. If I know the strategy is good and it's going to produce a profit, I'm okay if I have that worst case, but I only want to limit it. I'm okay if I have that maximum drawdown, but I want to limit it to 30% of my account if it happens. And that's going to be $4,500. So $4,500 divided by 600 pips means you can trade 7,500 mini lots, or 7.5 mini lots. That is, just for reference here, what you can do is, so you don't have to calculate this out each time. For this example, 7.5 mini lots is how many dollars? 75,000, right? So you can 75,000 divided by 15, and you know what your leverage is, and then you can just look at the leverage. So like when you're taking a position, just use the leverage. So take 75,000 divided by 15. So that's 5 times leverage. Then let's say your account grows to 20,000. You don't have to calculate this out each time. All you do is go 20,000 times 5 times leverage. Your position size is now 10 mini lots, which makes sense because your account's grown by 25%. So will your position size. So that's how you can quickly do this with avoiding the calculation each time. So on my charts where I use this maximum drawdown position sizing, all I've done is I make a little note and I say 4 times leverage, 3 times leverage, 2.2 times leverage. And I get that based on this calculation first, my account, or the position size divided my account, that tells me how much leverage I'm using, and then I can just continue to use that leverage amount. We can do it for stocks as well. So assume that you go through let's say you're back testing a strategy. You're looking at a strategy in Apple, and the strategy produces $50 in losses a month, and that was kind of its worst period. And by that I mean you're just going through and adding up. This doesn't have anything to do with position size yet. You're just going up and adding the dollars and cents you would have made on the actual price moves. So let's say you bought at $300 and sold at $305. That's plus $5. But then you bought at $320 and it dropped to $310 and you lost $10. So now you're minus $5. And you just keep doing that each trade. So you have a dollar amount, how much you're up or down. And then you can multiply that by your position size to see what your profit or loss is. So this is just based on adding up wins or losses. So for example, if the worst drawdown was you lost 10 trades in a row, losing $5 on each trade, that'd be equivalent to like buying at $300 and selling at $295, then that'd be a $50 loss. So if that's like your biggest drawdown, that's the amount we're going to use. Then again, you just decide what your drawdown percent is going to, what your drawdown is going to represent of your account. Say you're only willing to lose 10% of your account, or maybe you're willing to lose 30%, and you just plug in your numbers, whatever the maximum drawdown amount in dollars was, divided by the strategy loss in dollars, and you get what your position size should be. And again, this is assuming that your stop loss is about the same on each trade. Your trade risk is about the same. This is really important. So now that we have an idea of how the position size works, we want to make sure that we're building some safety into it. Because we're basing our position on what we think will be a maximum loss, if we end up with a much bigger loss than even what we've seen in the past, our account could get really hurt, because especially if we're increasing our risk and saying, you know what, I want to increase I'm only at a 20% drawdown, I don't mind increasing it to 40. You're doubling your position size. What happens if a bigger drawdown comes and now all of a sudden your account's down 60, 70%? That's really ugly. So we want to build in a bunch of safety measures. So first, we're going to try to use multiple years of data, hundreds of trades, do as much back testing as you can. If you have a 400 pip drawdown, you want to assume that 600 could happen. So you're actually going to increase whatever the actual drawdown is by 50%. So remember I was talking about that Euro USD strategy where it loses 600 pips at its worst point? That's not really true. It actually only loses about 300 pips at its worst time. But then I did this. I added in slippage on every single trade. So that brought it to about a 400 pip drawdown. Assuming that, hey, maybe conditions get volatile and I'm like getting an extra 5-10 pip slippage on like every one of these trades. I got to build that in. So I'm going to assume it only lost 300 pips during a really bad time, but I'm going to assume that it could actually take 400 pips, including slippage, and then I'm still going to increase it by 50%. And that's how I came up with that 600 pip risk. You want to do that, assume the slippage, and then if you don't have a lot of data or you're kind of a newer trader, I would double it. So if you add up that you had a 400 pip 400 pip loss, then you add in slippage and it's 500 pips, assume that you could take 1,000 pip loss. Build that in. If you make, the more robust you make your model and the more leeway you sort of give it to account for really bad periods, the better off you'll be, because you're still gonna end up with good position sizing, but you're going to avoid that situation where you just get destroyed by something you totally didn't expect, and which happens all the time. There's flash crashes, there's all sorts of things where you think that could never happen. I could never lose that much money on a trade, and then it happens. So at least build in these safety measures. Whatever you've seen in the past, just assume that it could happen. Whatever you've seen in your strategies, like the biggest losses you take, increase it by 50% or double it. I don't recommend drawing down more than 30%, even though risk equates to more profit if you know you have a winning strategy. That's a good point, though. If you don't know if you have a winning strategy, you don't want to increase your risk until you know that the strategy's been verified or you've done a ton of back testing. Trade small until you know it's profitable. I don't recommend drawing down more than 30% simply because if you start drawing down 40, 50%, the gains you have to make back to get back to even just keep getting bigger and bigger. At a 50% drawdown, you need to make a 100% return to get back to even. So if you had 100,000 in your account, you dropped to 50,000, you now have to get a 100% return to just get back to even. There are very few traders who can do that in a timely fashion. So the bigger the drawdown ends up being, the tougher it is to make that money back. Also, you start to get psychologically a little messed up because maybe you start thinking like, oh man, like I've just been annihilated lately. I'm going to take some trades off. I'm just going to sit on the sidelines for a bit. And then of course that's the time where the next like 10 trades are winners and you've sat them out. And then now you hop back into the market and you hit another losing streak, which your strategy didn't account for, because when you did your back testing, or maybe you traded before, you never took that break, you assumed that those winning trades were part of the strategy, and they should have been. But because for whatever reason we were mentally exhausted or whatever, we kind of messed with the strategy a bit by not being a part of those winning trades, and then we ended up with 2 bad periods in a row. So that's another reason why I say like account for slippage and add on to the maximum drawdown, because if you're sick one time and you just happen to miss a really big trade, that could be the difference between how the strategy performs over the year. Like if it's a really big trade, that could be the edge for the year or the week or the month, whatever it is. So we want to account for those things. In summary, we can make more or save more by factoring in our maximum drawdown. It's so important to know what your maximum drawdown is, and then you can really start fine-tuning how your position sizing is. And this is an alternate position sizing. It's not required, but it may give you a different perspective on how maybe you're over-positioned or you're under-positioned. And it may also just help you realize, man, I really need to know what my maximum drawdown is. Because if you don't know what it is, you're really trading blind, and you're either extremely susceptible to ruin, where an event occurs where you haven't taken that into account, there could be such a big move and it just wipes you out. There's also the possibility that you're underpositioned, and no matter what you do, your account just doesn't really seem to grow very much. And it could be because maybe you're a guy who only takes 5% drawdowns. You don't really lose a whole lot, but you're not taking really big positions, so you're not winning a whole lot either. That account's just kind of staying stagnant. And either way can be really detrimental because it messes with you mentally. And if you're the guy who actually trades pretty good, but your position sizing's off and you're not seeing your account grow, you're probably going to get frustrated, and then at some point maybe you take a gambling trade where it's way too risky and you end up blowing that money or something. So it's really important to know what your maximum drawdown is, so you can decide whether you're under or over positioned. Just a couple of refreshers here. Remember that 15% drawdown guy who was comfortable with 30% drawdowns? He could double his profit simply by doubling his position size. The person who wasn't comfortable with 50% drawdowns and wants to reduce it can do that by cutting their position size in half or a quarter or a third. So these were the 3 steps to find out what your position size is for the maximum drawdown. I'll let you read over those or skip back to the actual slides. But as a kind of bonus, I want you to think about something, and we talked about this briefly with just with the dollar position sizing, how you can fine-tune your leverage. With the amount of forex leverage that's available to us, even in the US or Canada, you have 50 to 1, and in some other, if you have a broker that's offshore, you have higher amounts of leverage. To be honest, I don't think there's much need for beyond 50 to 1. But if you are trading multiple strategies or uncorrelated pairs, and that means your losses and profits don't necessarily occur at the same time, the prices don't move together. So you want to look for this in uncorrelated pairs. But you can potentially double or triple your returns while also offsetting your risk. So what I mean by that is, let's assume you have one strategy, doesn't matter what market it's in, but let's say it makes 20% a year, and it has a drawdown of 10%. And you have another strategy which picks your trades based on a totally different method, or maybe it's the same strategy but you use a different currency pair which is uncorrelated with the other pair, or it's a different stock that's totally uncorrelated to the other stocks you're trading. And that one has, let's say, a 30% return for the year, and let's say it has a 10% drawdown too. So you have 2 trades, 2 strategies, or 2 investments. One has a 20% return, the other one has a 30% return, and they both have 10% drawdowns. Since those drawdowns, if you look to see if they don't occur at the same time, you can actually reduce your drawdown for the entire account, because if one's dropping while the other one's going up, your losses are offset in the account. So you want to make sure that those ones are uncorrelated, and then you've essentially double your returns. If you can trade both those strategies at the same time with the proper position sizing, you get the 20% from the one and the 30% from the other. So you end up with a 50% return, while also potentially reducing your risk if they don't move together. And so that's thinking about maximum drawdown. You can really start to fine-tune your portfolio. You just want to be very careful how you're combining the strategies and investments, so that you don't end up over-risking yourself or ending up with double the drawdown you expect. But that's something to think about. It'd be a whole other webinar to go into, and I'll try to do it one day, where we talk about how we can combine strategies and uncorrelated pairs to help boost our returns and also reduce our risk. But for now, I just want you to think about it and also think about the max drawdown. So until next time, I hope I've given you lots to think about. Happy trading, and stick to your trading plan, whatever it is. This isn't something you need to do, but start thinking about it and how it can be incorporated into your trading.